How did you start Auctos Capital?
Auctos Capital Management was sort of what I mentioned to professional money management. It was like the next phase. And Auctos was a CTA, commodity trading advisor. But prior to that, I had started a proprietary trading group. And from there was always a lot of debate about, because now you're off the floor, right? As far as what strategies work, what strategies don't. And so we always talk about it. And eventually we're like, listen, there's one way to find out. Let's back test everything and figure out what is the actual viable strategy and what's not. So we put a team together of programmers and quants and so on. And so we were able to slowly come up with the strategies that we thought were viable. And then we traded it with our own funds for a year. That gave us enough confidence to be able to launch officially. So we officially launched Auctos Capital Management in November of 2007. Auctos, actually, it's like a Latin word that means like persistent growth. And the correct spelling is Auctus. But when I Googled it, there was another company that had a similar name. So I try to misspell it on purpose just so it would be unique. Plus, I wanted something that starts with the letter A because in all it shows up if you ever look at the database of all the managers, the alphabetic order. So having the A, and I like the meaning, for me, persistent growth, evolution, those are all things that really resonates with me.
How long did Auctos Capital run?
Auctos ran for 10 years. Initially, I started, and then about 2 years into it, that's when, John Yavari, John Ruth, and Brian Ruth also became partners into Auctos. And we ran it for 10 years. We had a 10-year audit track record. And during that 10 years, so we started in November of 2007, which obviously 2008 happened right after that. But during 2008, net of all fees were up 14%. So it was definitely a good start. And, one thing is a lot of people always ask about like how much should a return, which is relevant. But the key question that people should ask is, how much risk did you take to get those returns? So for me, it's always about risk adjusted returns. So in that context, in a 10-year track record, our worst peak to trough monthly drawdown was a little over 12%. And we're like averaging, I think, a little over 6% annualized return with an 8% volatility. And from my end, and we were able to, by the way, outperform all our benchmark indices during that time. And from my understanding, what I've been told, I think we're one of the only emerging managers left standing from a time like with our peer group that we started in 2007, because it was a very difficult 10-year because the equity markets, ripped higher. And there wasn't much appetite for alternative investments.
What was your trading strategy?
It was a 100% systematic fund. So meaning, even though we implemented the strategy, but all the signal generation, everything was 100% systematic. And that was very important for me because, we don't want human emotion getting involved. But as I've alluded to, this evolutionary phase for me, we initially started as a trend following, but then later on we evolved into more of a multi-strategy fund where we're trading, different sectors, different markets, different timeframes, different strategies. And even within the strategies, we're doing relative value, calendar spread, pattern recognition, and different timeframes for the trend. So it was truly a multi-strategy, 100% systematic fund.
What made you decide to move on?
The fund strategy, it turned into a mutual fund as well. So we did a partnership with Catalyst Funds, which is, I think, one of the best alternative investment fund companies. As I mentioned, those are some of the toughest 10 years for the alternative. There wasn't much appetite for alternative investments. And for me, once I realized that I can't continue to evolve the research, because I always want to add more people, more manpower, and continue to beef up the research department. But given the environment, I knew that, that's not possible. I figured maybe it's best, it's had a nice run, 10-year track record. And by the way, all my investors, like on the CTA side, on the managed account, everybody was above their high watermark. So everybody was profitable. So I figured, maybe it's time to look to transition to something else where I could, use my skill sets to add value. One of the, areas that was always in back of my mind, and as I mentioned, towards the end of it, being a mutual fund manager. So I got my first exposure to the wealth management space. One thing I noticed is from an investment management perspective, there's a lot of inefficiency and it was really ineffective. A lot of these advisors, they meant well, but they just weren't properly trained because it's more of a relationship business, right? Their backgrounds aren't in portfolio management. So I thought, there's a lot that could be done there. Once again, from an investment management perspective, there's very little what I call like conscious portfolio construction. There was no really concept of risk management. Very little portfolio diversification. I mean, you'd see, and to this day, I still see it, people with like, 30, 40 things in their statements. But at the end of the day, you run a simple correlation analysis, they basically have two positions on. You know, basically it's all either tied to equities or fixed income. That was sort of the direction I was leaning towards, but it took me a while. I had my hesitation, and finally I was doing like the rocking chair test. I don't want to look back and say, what if, what if? So after giving it a lot of thought, I'm like, you know what? I'm going to make a run for it, but only if I could find the right firm who sees things similarly as I do, meaning where the industry, it's really inefficient. It's due for disruption and ways of being able to, improve it and do things much, much better. A place that it's unbiased and objective. It's open architecture. One thing that was important for me, that it's open to new ideas. I can't tell you, and like I mentioned, I spoke with like 20 different firms. How many firms, John, I would go talk to and say, well, I think, and then they would say, wait, did you say you think? No, your job is not to think. Your job is just to go bring in the next client, and we're going to put them through the machine, right? Just simple cookie cutters, 60/40, and so on and so forth. A place that, understood the importance of alternative investments. We had easy access to it, that I could be able to implement it. For me to just have the freedom of doing what I thought it's best for the client's interest. But it was also through that process, I was so laser focused on one aspect, which was investment management, that I really got to learn about the holistic approach, that truly the best way to really impact someone in the context of wealth management is to have a holistic approach, where not only obviously investment management is a very important piece of it, but there's other aspects of it. So then the key became for me to also look at a place that has a team with people with similar expertise as I do in their respective fields, such as, financial planning, estate planning, tax mitigation strategies, and et cetera.
What do you mean by conscious portfolio construction?
Unfortunately, nowadays, the term consciousness, mindfulness, all this stuff gets thrown around loosely in this kind of like new agey, flaky type stuff, without really people having a deep understanding of what it is. And for me personally, the word conscious, being conscious, it applies to all aspects of my life. It's something that I try to center everything. It's a center of the basis of how I try to live in different areas. But as it relates to portfolio management in this conversation, I think I could use let's use the example of alternative investments. Now, this applies to other aspects of it. But since we've been talking about alternative investments, we can use that. So a lot of times what you see is a lot of places, they have this mandate. It's like this generic 5%. They just want to check the box and say they've allocated to alternative investments. And they'll just pick something that says it's alternative and they put it in, done. In my opinion, if you want to take a conscious approach, is first of all, you start with, is this an alternative investment to begin with? Because a lot of times, and now I see it, is it alternative because the salesperson or the wholesaler says it, or you've done your own analysis? So the first thing I do, I don't listen to, someone saying this is an alternative investment just to say I've done it. I run a correlation analysis to see, because for me, if I'm allocating to that bucket, I want something to be different. From there, instead of just looking at a 1 year, 3 year, 5 year track record, I do a deeper dive. I run my own analysis. I run the track record and look at all the different quantitative metrics, drawdown, Sharpe ratio, and all those other variables. Then I take another step within the alternative investments sleeve. I try to diversify it instead of just doing it with one manager. But then in the process of diversification, then I run another analysis of seeing how does it blend with the rest of the portfolio, right? So these are all like instead of just being like a machine, taking a very methodical approach. You run a correlation analysis, how does it behave with the rest of it? And the position sizing. Why am I, what's the number? Is it 1%, 2%, whatever the percentage is? Why am I allocating that much position? And what is the objective of this part of the portfolio? And I could go on and on and on, but the other thing is also understanding its behavior, right? And that's key. So you don't become an extension of the investor, because a lot of times what I've seen investors and a lot of advisors make the same mistake. They're looking for something that's going to linear move up. Everybody gets in here, And then once it's down here, everybody's getting out. I like to do it the other way. I want to get in when it's falling down, so long as I understand the behavior of it and have some sense of expectancy of returns and understanding what the worst drawdown is and trying to buy into drawdown. So let's say a fund that, historically has had a 15% max drawdown with, 15-year track record, and that you've already talked to the manager, they're in a 10% drawdown. You want to take advantage of those drawdowns. So it is a lot of other, this is what I'm talking about, a conscious approach versus, and it takes time. And I understand why, a lot of people probably don't want to do this besides not having the expertise because it takes a lot of time and effort. But this is, to me, is one example of taking a conscious approach of factoring in all these different variables before you implement it into a portfolio.
What are your thoughts on AI?
Clearly, that's the direction that a lot of industries are going. And I think as it relates to our industry, it's whoever is going to be able to leverage technology, whichever firm, it's going to be ahead of the curve. There's no question about it. Having open architecture and unbiased approach is also, I think, it's going to be significant in terms of the future of wealth management. From a performance perspective, I think alternative investments, more and more investors are understanding the benefits of it. Being able to understand them and utilize them properly in a portfolio is going to be key. And quite frankly, retail investors are getting a lot more sophisticated because they're like, well, I could do a 60-40 myself. What do I need you for, right? So I think the demand is more towards institutional quality portfolio construction and portfolio management. So being able to have those tools and skill sets. I know I keep talking a lot about performance side of it, but also really truly bringing a holistic approach offering to your clients, meaning where you could, not only tackle all the things that I talk about on the portfolio management side, but being able to, have expertise in the team in all other respective fields of financial planning, estate planning, taxes, and so on. And where you don't have to be a jack of all trades and master of none. And at the end of the day, quite frankly, it's running a clean business and being honest with the investors, not kind of dinging in with fees all here and there without them knowing, because there's so many ways, unfortunately, that clients could be paying for fees that they're not aware of. And then I think nowadays things are becoming more and more transparent. So the more you're running a transparent business basically treating everybody like how you want to be treated, as simple as it gets. I think that's going to be also another added vantage point.
If you started over again, would you do anything differently?
I tend not to reflect on the past that I can't change, but on the future that I can create. Of course, there's a million things that I think I could have done differently and I should have done differently. But the question is like taking some of that and saying, okay, how can I apply it moving forward? And I think the key thing is always evolving and being able to roll with the punches, right? Always seeing, like, we mentioned AI. Okay, instead of saying, oh, is AI going to replace me or my industries? How do I best, work with it and incorporate it to enhance my business? So that's how I try to sort of look at things and as we move forward.
What advice do you have for someone just getting into the industry?
One of my colleagues had a friend that his son wanted to drop out of college and start trading futures. And I said, listen, if this was back then, and because I'm not going to just generically say, no, you should stay in college because of, you shouldn't do this, this and that, right? There's context to everything. I said, if this was back in the day and where we knew the picture eventually going to go away and there's this opportunity, I'd say actually do it because you have a short amount of time to take advantage of this thing. However, if your goal is to be in this industry and you want to become successful at least from my perspective, is I would go, obviously I would stay in school because back then the reason people were successful on the floor was the edge. So now there's no longer an edge. You have to create that edge. And the only way you can create that edge is belonging to one of these sophisticated, obviously trading shops as far as the trading goes, right? Some of the biggest firms that we know, the hedge funds and so on. So in order to get there, you want to stay in school, load up on math and science classes, physics, statistics, math. At the bare minimum, you get your bachelor's degree in one of those, like math, physics, or whatever it is, or engineering related, not business administration. And then if you want, it doesn't hurt, you get your MBA and then slap on your CFA. Now you're fully equipped and you have optionality. right? So you have both the qualitative side of it and the quantitative side, and then you could kind of go on the market and then see how far you can take it. So that would be this was actually a real life conversation I had with someone that this was my advice to them if they want to become successful in this industry.